Hi, this is Ken Boyd with the Accounting Accidentally website. You'll find over 300 blog posts here on the website, and also if you slide down, you'll find links to over 400 YouTube accounting videos. I'm going to hop over here and go full screen because I'd like to talk about liquidity ratios. This is a portion of a spreadsheet that I use to explain the topic. The important thing to remember on liquidity is we're talking about in the short term, does a company generate enough current assets to pay off current liabilities? And the focus is on the current period, which is 12 months or less. So working capital and current ratio are very similar. Working capital, current assets, less current liabilities. You want a number that's a positive number, more assets than liabilities. Current ratio, on the other hand, explains it as current assets divided by current liabilities. You want at least $1 of current assets or more as compared with your current liabilities. So you want a positive ratio, more than one, or a positive working capital number, positive versus negative number. Quick ratio subtracts inventory, the theory being that inventory takes the longest to convert into cash. Of your current assets, inventory takes a lot longer to convert into cash in some cases. So let's subtract that and then look at current assets less current liabilities. Success in business is a lot about creating turnover and collecting money quickly. So we have receivables turnover, which is net credit sales, divided by your average gross receivable, average being beginning balance plus ending balance divided by 2. So of the items that you sell on credit, meaning you don't get cash right away, what is your receivable balance in comparison? The idea is to create a really big numerator, lots of sales, while minimizing your receivables in the denominator. So if you have an increasing turnover rate, that's good. You can look at how long it takes to collect all of your receivables on average, which is average days to collect or average collection period. 365 divided by the receivable turnover ratio we figured out up here. Fewer days is better. Fewer days, better. Inventory turnover looks at cost of goods sold divided by your average inventory. And again, we want a lot of sales and cost of goods sold in the numerator. We want to minimize the inventory in the denominator. A high ratio is better. And finally, how long does it take you to sell your inventory? Similar to how long does it take you to collect money? 365 divided by the inventory turnover ratio we figured out up here. And the fewer days it takes to sell inventory, the better. So that's a quick overview of that topic. If you go over to Conference Room, you'll see the article on the new book I'm writing for 2020, 25 Intermediate Accounting Spreadsheets and how to use them. You're going to get a written text, spreadsheets that I use in my videos, and the YouTube video that explains the concept all in one document. Comes out next year, and if you have an interest in getting sample chapters, email me at ken@stltest.net and we'll send you sample chapters. Thanks very much, and we'll see you next time.